Understanding net present value of growth opportunities, NPVGO. The net present value of growth opportunities, NPVGO, is a critical financial metric that evaluates the intrinsic value of a company's expected growth opportunities. Calculating the NPVGO provides investors and analysts with insights into how much of the company's current per-share value is attributable to anticipated future cash flows from new projects or acquisitions. This article will delve deeper into the concept of NPVGO, its calculation, its significance, and industry-specific considerations. What is NPVGO? NPVGO quantifies the net present value per share of all future cash flows related to growth prospects. It's a useful tool for investors looking to distinguish between the company's current operational performance and its potential for growth. By elucidating the value derived from future growth opportunities, it aids in investment decisions and pricing strategies during acquisitions. Calculation of NPVGO. The formula to calculate NPVGO involves two essential components: projected cash inflows and the initial investment required for the project or acquisition. The basic formula can be outlined as follows. Text, NPVGO, equals frac, text, projected cash inflows, open parenthesis 1 plus or close parenthesis to the power of n, text, initial investment. Where projected cash inflows, expected future cash flows from the proposed growth opportunities. R, discount rate, firm's cost of capital. N, number of periods over which cash flows will be realized. To contextualize, consider a company whose intrinsic value is calculated based on its current and future earnings, where the cash flows from growth opportunities contribute significantly to the overall valuation. Segmentation of share values. The company's share price is fundamentally an amalgamation of its current earnings and the anticipated future earnings due to growth. Through the dividend discount model, DDM, we can segregate the value per share into components that come from present earnings and future growth. 1. Current earnings valuation, discount the current earnings per share by the cost of capital. 2. Future earnings valuation, discount future cash flows expected from growth opportunities. This segmentation provides investors a clearer picture of what portion of the company's value is sustainable based on present earnings versus what can be attributed to growth projections. Significance of NPVGO. Decision-making tool. NPVGO serves as a powerful tool for making crucial business decisions regarding investments, acquisitions, or resource allocations. Understanding the value of growth opportunities helps senior management evaluate whether pursuing a new project will add value to the shareholders. Pricing strategy in acquisitions. In negotiating acquisitions, NPVGO provides a grounded approach to determining a fair price by valuing the anticipated cash flows generated from the target company's growth opportunities. This strategic valuation can lead to better informed decisions that maximize shareholder value. Risk assessment. As projections are rooted in assumptions about future performance, it's essential to identify and exclude non-standard cash flows, such as those associated with discontinued operations, that could distort these projections. Ensuring the integrity of the projections plays a fundamental role in risk assessment and management. Industry context and variability. Valuations resulting from NPVGO calculations are not universal, they are highly specific to individual industries and sectors. For instance, technology companies known for rapid growth may exhibit a higher NPVGO due to higher expected future cash flows, whereas capital-intensive industries may have a lower NPVGO due to significant upfront investments. Example analysis. To elucidate the calculation of NPVGO, consider the following example scenario. Intrinsic value of stock, $64.17. Cost of capital, are 12%. Current earnings per share, $5. Future earnings per share, growth 90 cents. Growth rate, G 8%. Calculating the value of current earnings. Backslash text, current earnings value, equals backslash frac, 0.12, equals 41.67. Backslash. Calculating the value from future growth opportunities. Backslash text, future growth value, equals backslash frac, 0.90, 0.12 to 0.08, equals 22.50. Backslash. Adding both values together gives. Backslash text, total intrinsic value per share, equals 41.67 plus 22.50 is equal to 64.17. Backslash. This example illustrates how both current earnings and anticipated future growth can converge to determine the stock's intrinsic value. Conclusion. In summary, the net present value of growth opportunities is a vital financial metric for assessing the value attributed to a company's future potential. It allows for a clearer understanding of the present versus future contributions to share price, providing valuable insights for investment decisions and corporate strategy. Investors must consider industry-specific factors as they analyze NPVGO, as each sector will present unique opportunities and challenges that impact growth potential. Further reading. Valuation techniques. Explore various methodologies for valuing companies such as DCF, comparables, and precedent transactions. Financial projections. Learn how to develop accurate and reliable financial projections for better NPVGO assessments. Risk management strategies. Understand the importance of sound risk management in making financial projections and valuations.